The S&P 500 is knocking on the door of 7,000. A small group of AI megacaps is carrying a huge share of the gains. Markets look strong, confidence is high, and a key recession indicator is no longer flashing. So the question is simple. Are prices just running a little ahead of reality, or are we setting up for something more painful that no one wants to see yet? To answer that, I start with Gemini's analysis, and then briefly contrast it with how ChatGPT approaches the same questions. I ran 4 prompts through both models: the biggest market crashes in history and the warning signs that preceded them. Whether those same red flags exist today, the odds of 10, 20, and 30% drawdowns in the near future. And as a bonus, whether today's AI-driven boom really resembles a late 90s style tech bubble. Along the way, I'll highlight where the models line up, where their assumptions diverge, and what those differences tell us about downside risk. Let's start with Gemini 3 Pro. I asked it to rank the biggest US stock market crashes of the last century by how much damage they actually did. At the top is 1929, which fed into the Great Depression and stands apart with an 80+% decline. Many of the most severe drawdowns, however, are far more recent: the global financial crisis, the dot-com bust, and the COVID crash. Across those episodes, markets lost roughly a third to more than half of their value. It's also worth noting that a 30% drawdown is not unusual. These declines recur repeatedly, sometimes within less than a decade of one another. Which raises the next question: what conditions tend to appear before markets experience losses like these? What matters isn't any single crash. It's the pattern that keeps repeating before markets turn sharply lower. Across history, 4 things tend to line up before major breaks in stock prices. First, the economy starts to lose momentum. Growth slows, earnings expectations stop rising, and sometimes a recession is already visible. Unemployment usually lags, but early cracks often appear, and that's where turning points tend to surface. Second, monetary conditions tighten. Before most major crashes, the Federal Reserve aggressively raised rates. The bond market often sees this coming first, which is why the yield curve may invert. As policy tightens, credit conditions follow, and markets that relied on easy money lose support. Third, valuations get stretched. Prices drift away from fundamentals, and you see it in elevated price-to-earnings ratios. This is also when market leadership narrows. A small group of popular stocks carries the index, while the average stock quietly weakens. That kind of concentration is a warning sign. And finally, there's usually a catalyst, something external that forces the large adjustment in prices. Sometimes it's geopolitical, sometimes it's financial, and sometimes it's what nobody was planning for, like a pandemic. These conditions don't guarantee a crash, but when several of them line up at once, markets become far more sensitive to bad news. Next, I asked Gemini if the conditions that tend to precede past crashes are present in today's market environment, and I liked what Gemini did here. Instead of working through a long narrative, the AI summarizes its findings in a concise table with the warning signal, where it stands today, the risk level, and a short explanation of what's driving it. This is followed by a more detailed explanation further down. We can take this in quickly. Growth is currently slowing but not collapsing. Monetary tightening appears to have paused. Valuations, though, are clearly stretched. And geopolitical risk, Fed transition uncertainty, along with AI fatigue, increase the risk of volatility shocks. One interesting point I see is this. Gemini notes that the yield curve has uninverted and turned positive, a shift that historically occurs late in the cycle and often just months before a recession begins. In other words, the move back toward a normal curve does not eliminate recession risk. Rather, it can signal that the economy is often associated with the later stages of the business cycle. Markets rarely break for one reason alone. Stress builds when several signals start pointing in the same direction. It shifts the focus away from calling a single outcome and towards a pattern where vulnerability is accumulating. That same framework shows up again when Gemini lays out the downside risks to the current rally. Each risk is tied to a mechanism, a trigger, and a plausible market impact. Inflation re-accelerating, deterioration in the labor market, and the concentration in the Mag 7 all show up here as distinct paths by which pressure could spread. Let's move to the following prompt, where I asked Gemini for hard numbers: the probability of 10%, 20%, and 30% drawdowns over the next 3 months, 6 months, and 1 year. These are run twice, under 2 different assumptions. The first table is the baseline view. This is what you get if markets behave the way standard financial models say. Returns follow a smooth distribution. Volatility stays roughly where it is today, and extreme outcomes remain rare. That's the world implied by the VIX. Under those assumptions, corrections are common, but deeper drawdowns are treated as unlikely. A pullback of at least 10% is probable, with an 82% chance over the next year. A 20% decline is much less likely, at roughly 16%, and a 30% crash sits deep in the tail of the distribution, with odds of just 2%. Now looking at the second table, the assumptions change. Instead of a well-behaved market with normally distributed returns, this version adjusts for the current conditions we just walked through: elevated valuations, yield curve dynamics, macro slowdown risk. In essence, the model is effectively reflecting the fat tails and regime shifts that standard implied volatility models tend to understate. Once you do that, every number moves higher, and not by a little. Every cell in the adjusted table is larger than its counterpart in the standard model. Accounting for today's risk environment pushes downside probabilities higher across the board. But the more important shift isn't just the level of risk. It's how the shape of the distribution changes. In the standard table, the market looks fairly well behaved. Big corrections are possible, but deep crashes look like long shots. In the adjusted table, everything shifts up. A 10% pullback rises to 90%, and the 30% crash jumps to 18%. The point is not that a crash becomes the base case, but that the left tail gets heavier once you layer in today's valuation and macro backdrop. So the takeaway is simple. The market can keep grinding higher, but the downside is no longer priced like a clean, low-vol regime. The same rally can coexist with meaningfully higher odds of a deeper air pocket. Before we continue with Gemini, I want to pause and compare what we just saw with what ChatGPT came back with. This is ChatGPT 5.2 running in thinking mode, which is the closest analog to the Gemini model we've been using. I ran ChatGPT through the same set of prompts, and the themes to the first two queries were very similar to what we got from Gemini. However, the delivery of information from ChatGPT tended to be more narrative and text-heavy, which may appeal if you want every assumption spelled out step by step. Gemini, by contrast, compresses those ideas into a tighter framework, making it easier to scan and compare. There are also noticeable differences in their modeling schemes, which show up clearly in the latest output on drawdown probabilities. First, the two AI models are not making the same volatility assumptions. Both are calculating the odds of hitting a drawdown wall, but they are feeding the model different inputs. Gemini is closer to cruise control. It largely assumes today's calm VIX reading of 16 stays flat, which keeps its crash odds relatively low. ChatGPT, however, looks at the term structure. It sees that traders are paying a premium for protection a year out, with the VIX rising from 16 today to over 22 next year. Because ChatGPT bakes in that future storm, its model naturally spits out much higher odds for a major crash. When ChatGPT adjusts for crash commonalities, the result is a shift in probabilities toward more extreme outcomes. The one-year probability of a 30% drawdown rises to about 26%, compared with roughly 18% in Gemini's adjusted model, indicating that ChatGPT's framework places greater emphasis on tail risk once crash dynamics are incorporated. Both AI models, however, point in the same direction, towards higher crash odds when we adjust for today's environment. But we need to highlight the one metric where Gemini clearly dominated the answers to our prompts, and that's speed. To ensure a fair apples-to-apples comparison, I pitted Gemini 3 Pro against its equivalent, ChatGPT 5.2 thinking mode, running both in newly opened chats. As you can see in the table, the difference in response time is drastic. While ChatGPT needs a few minutes to process these complex queries, Gemini delivers results in less than a minute. For this type of heavy lifting at least, Gemini is the clear winner on efficiency. I want to now add observations from a bonus question I posed to Gemini about the AI sector, because they help clarify where current market pressure is concentrated. AI-related stocks currently show late-cycle traits that echo the dot-com period. Where the comparison breaks down is valuation quality. Unlike in 2000, today's market leaders are highly profitable, cash-generating businesses, which changes the risk profile. The more concerning parallel is revenue circularity. Large platforms are funding AI startups that then spend heavily on services from the same firms. That can inflate reported growth even while end-user demand is still forming. A similar feedback loop existed during the late 1990s telecom build-out, and when it broke, revenues fell quickly. Capital spending adds another layer of risk. AI infrastructure investment is being pulled forward aggressively out of fear of falling behind. This resembles the fiber optic overbuild of the late 90s. The infrastructure may eventually prove useful, but if adoption lags, spending cuts can ripple through the semiconductor and equipment supply chain. Finally, concentration. The market is more top-heavy today than at the dot-com peak. A small group of stocks dominates index performance, leaving even passive investors exposed to a single theme. If the AI trade cools, the same mechanics that amplified gains can accelerate declines. So the takeaway here is that the market is late cycle and fragile in specific ways, vulnerable to repricing, slower growth as excess investment is worked off, and crowded positioning. That context lines up with what we saw earlier in the downside probability tables. So whether you're a fan of Gemini, ChatGPT, or any other AI model, the current environment signals elevated downside risk even as stock prices continue to make new highs. Be sure to subscribe for more and check out my other finance videos on the channel. Thanks for watching.